Yes, you are listening to the Ready, Set, Retire radio podcast with Steve Anzoni. My name is Jessica Forkel. Get more details on the website at fairwayfinancial.net. I do real quick want to talk about our friends at the Fed because, their first interest rate cut in 4 years, it was pretty aggressive. Instead of just a quarter point, they went big with a half-point reduction. Here's J.P. Morgan's David Kelly on CNBC.
Cutting interest rates at the start doesn't stimulate the economy at all. It actually slows the economy because people begin to anticipate those lower rates, so they want to wait for lower rates. It tells people that the Fed is scared about unemployment. I don't think they really should be, but that's the message it gives, so it undermines confidence. Bringing rates down from a high level is like bringing a piano down as a flight of stairs. You've got to do it very carefully and very slowly. That would be the right way to do it, and I'm a little worried they've started off in a rush here, but I do think this economy is strong enough to deal with percent, so I think it's still a healthy, strong economy.
Okay, so back to the theme that we were just talking about here, a lot of uncertainty of where things are going. And, I know the Fed, they're expected to do some more cut rates through next year. But the bottom line is, Steve, what are you telling folks when they call up concerned?
Well, that's kind of weird messaging there by Mr. Kelly. He talks about, it's really, really aggressive, like moving a piano down the stairs. And then he says, no, I think we're okay. So which is it? But anyway, that's how it goes with these things. You could never guess what the Feds are going to do. You just can't. Like for 4 years, they haven't done anything. And it was very shocking that they waited so long to do it. So maybe this is their way of catching up a little bit. But we all kind of expected the interest rates to come down a little bit. We've seen it in banks and in CDs and some short-term annuities. But it hasn't come down that hard yet. The mortgage rates obviously were helped out by it, which is great. The problem is there's still no inventory. Prices haven't moved. As a matter of fact, some argue that because the rates are lower, people are raising the prices of the house.
Yeah.
So it's like double-edged sword there. So I always try to say to people, look, you can't plan your future based on what the federal government's going to do. You just can't. You have to look at your situation, where you're at now with your money, and the focal point has to be income. And it's funny, you mentioned earlier people being concerned about running out of money. So one of our callers last week I got to meet, super nice guy. I'll give a shout out. I'll just say his first name, Peter. Thank you for calling in and coming in because I know he's listening to the show. That's the first thing he said. I'm concerned about running out of money. And he showed me his portfolio and what he was taking out. And it was a pretty aggressive drawdown that he was taking. And, I just pointed that out saying, you're taking around, 7% of your portfolio, 6.5%. And that's a pretty aggressive draw. And it's not guaranteed for life, which he knew, which is why he came in. So we had a nice chat about that. And I shared with him some solutions on how to fix that and guarantee twice.
Now, October is one of the most feared months, but it's not because, of course, Halloween, they got the ghosts and goblins coming out, folks. It's because in the past, we've had some crazy financial situations happen. In history, some of the biggest events that shaped the stock market, including the bank panic of 1907. Just to give you a little recap here, it stretched for 6 weeks and resulted in bank runs and panic selling. And then you got the stock market crash of 1929. We've all heard of that, the Great Depression. And number 3 here, Black Monday, back in 1987 when the Dow dropped 22%, but it did recover quite quickly. So it's led to what's called the October effect. And it's the psychological anticipation that Wall Street crashes are more likely to occur in this month than any other. So, Steve, I got to know, is there some truth to this? Have you seen this? And should we be paying attention to these historical events to see what will come in the future?
Well, there's clearly some truth to it because you just named 3 things that happened in October, right? So, look, the closer you are to retirement, the more critical it is to protect what you've saved. That's simple. And if you're already in retirement, and you're drawing on those funds, that's when it can hurt the most because $500,000 with a 20% loss brings you to 400 and you're still drawing the same check. So if you were drawing 25,000 off of 500,000 and now you're drawing 25,000 off of 400, it's a big difference. So you got to be aware and cognitive of it. unfortunately, we're never going to know when it happens. We'll know after the fact. But it happens, and you need to be prepared, and that's why I have the buckets of money that I do, Jess, and why I stress that you can't have all your eggs in one basket. The idea is to understand why you have the money. I know what you're thinking, Steve. I know why I have it, because I want to retire. That's great, but that's too broad of a statement. You want to retire how? Like, how much income, cash flow do you need? That's what you should be asking yourself. And how can the money that I saved produce the income that I need for as long as I need it? We can't control what goes on in the market. We know it's going to go down, and we know, it's going to go up. I mean, that's just been history, and it is what it is, as the saying goes there. But to have all your eggs in one basket, I think just doesn't make any financial sense at all. And I think everybody who comes into my office and sits down, we talk about this. And I say to them, look, by default, most Americans have all their eggs in one basket while they're working. And it's called a 401k, a 403b, an IRA. That's just the way to go, the simplest way to save for the future. There are more complicated ways that involve a little bit more knowledge, like real estate. But you got to understand how to buy the real estate, how to offer it up for rent, and all that stuff that comes along with that. But it could be another amazing opportunity if you're educated enough for it in that area. But most people default to 401ks and 403bs because it's easy, it comes out of their check, and they don't see it. But what you have to focus on more than just the savings part is, okay, I'm putting this money away for the future, and that's awesome, but what can I expect for a paycheck? I'm earning X a month now, and I'm going to need X a month when I retire. How can I do it? We all know Social Security is not going to do all of it, but at least it's there and it's guaranteed. So if you have these type of concerns, if it's keeping you up a little bit at night, if you're trying to figure out, I'm going to go on the internet and figure it out, and you try to do that and you find yourself going down a rabbit hole, getting even more confused, you're not alone. Okay? A lot of people have called me and said, Steve, I've tried. I've looked this stuff. I've looked at mutual funds online. I've looked at annuities online. And it's just, my head was spinning. And I said, well, that's why I'm here, because I've got all these years in, and I can help you sort things out. So let me help you do that for you, and let's coach you along, because everyone needs a coach in life. And I've been doing this a long time. I've got a lot of experience, and I would love to just give you some guidance. So, give us a call at 508-552-3230, or you can visit the website at fairwayfinancial.net, and you can go right on there and just post a message or say, hey, I see Steve's schedule, and I'm going to just throw myself in there and set yourself up for a call. Or if you want to come to our beautiful Hyannis location, it's a little easier to get to now with all the tourists, but and it's a beautiful time of year, really. I love October. I really do. It's one of my favorite months. And come on down, and we'll have a nice chat. We're right near, right on Main Street here, behind Columbo's. So we'd love to see you and hear from you. So there you go. There's my speech on that. 508-552-3230 or fairwayfinancial.net.
Now, Steve, just a few moments ago, you mentioned the whole 60-40 idea. A lot of folks, they use that, 60% stocks, 40% bonds. The mix was hit hard when bonds collapsed under the weight of higher interest rates. But now the Fed has begun cutting. So what does that mean? Well, Morningstar's Jason Kephart, he was asked what's next for the next 60-40, and here's what he said.
So I think the trajectory for the bond portfolio is looking pretty attractive, especially from that defensive characteristic. So all the hand-wringing we've done over the last few years about the bond portfolio, I think that's over. I think we could rest easy on the bond portfolio for the foreseeable future. What it means for the stock market, we'll see. Recession fears are out there. Stocks are not going to do well in a recession. And you also have a lot of mega cap stocks like, everyone calls them Magnificent Seven, trading at very high valuations. So if there is a repricing, that can be kind of painful for the 60-40. But I think in terms of like the construct and the philosophy behind why you want to combine stocks and bonds, that's very sound. I think that's in a better spot than it's been since 2021.
So, Steve, what are your thoughts about this? And, of course, what are your thoughts about the 60-40 portfolio split here?
Man, first of all, I think you should run for office, because I don't know what to take from what he said. It's like
Says a whole
well,
lot,
the
but
bonds-
nothing at all. Yeah.
Yeah, I think they'll be fine. You know, we've done some hand wringing, but the stocks might be not doing well in recession. Then you get the Magnificent Seven. I mean, I know what he's talking about, but most people think it's some superhero collection or something. But he's talking about the Magnificent Seven. Out of the here's the scaring part: out of the Fortune 500 stocks, there's only about 7 that are performing above, okay, and actually are making a gain. So that alone should frighten you to think that there are 500 stocks out there that you're investing your money in, and only 7 of them are positive. So that should tell you something right there. But it's just a lot of words, which I expect from people with suits and ties. And I just say, look, we don't have a handle on any of this stuff. We don't have control on it. We just know that long-term stocks generally go up. Mm-hmm. And generally, they're a great inflation hedge. And so that is nice, especially in times of inflation, to have something like that. Of course, the challenge is that they don't guarantee a cash flow or an income. So on one side, you got people who want their money to grow, of course. And on the other side, you need lifetime income. How do you balance those two? Because they're not in the same boat. They're completely different objectives. And so, again, you have to look at the bucket approach instead of the confusing graph approach that is on everyone's statement that's 20-something pages long. And, I mean, no one can figure that out. I mean, it doesn't really give you anything. I mean, I've seen some 401k, some 403b statements with funds and all that stuff in there that give you projections of cash flow on them in the future. And people have come in with those pages and they've said to me, okay, Steve, I've got this much money here and this statement says that I can expect $4,300 a month. And I just shake my head and I go, wow, they're getting bold. They're putting this stuff on paper and there's zero guarantees on it, but they're just trying to give a hypothetical on what you can potentially expect. And I'm sorry, but when I retire, I want to retire. I don't want to potentially retire. I want to retire. And I want to know that I'm going to have this cash flow for life. And it's not going to be dependent on who's in office, what's going on in the economy, or anything like that. Okay? I need some certainty. And of course, putting all your eggs in that one basket might not be wise because it limits your accessibility to the money. So that's why I created these buckets of money. And you need an income bucket, number 1, which is designed to do exactly that. Give you a check for life. And if you're married, both of you get the same check for life. It's not reduced. So to me, that's numero uno. Then the second pile is, of course, you got to have a hedge for inflation, where I think, you know, these 401ks and IRAs do a decent job of that, as long as you're not tapping on them very heavily every month. And then, of course, the emergency funds. We all know we need money in the bank for emergencies. I mean, at least this time we feel like at least we're getting paid, you know, for leaving some money in the bank. Although, let me tell you something. I had someone come in who called, and I looked at his money market statement, and this particular bank was still paying him 0.01, Jess. Isn't that pathetic?
That is ridiculous.
And it's like your cable company. They're not going to call you out of the blue and say, hey, Mr. Jones, I have great news. I'm going to reduce your cable bill. Your bank's not going to call you and say, hey, I have great news. We're going to increase your interest rate. Why? Because why should they? If they could pay you 0.01, they can keep more money. So it's up to us to look at our statements and say, wait a minute. I have a money market account. I should be getting at least somewhere around 4% today. So that's what I did. And the gentleman just called me the other day and he said, thank you very much. I went to my bank and made some changes, and now I'm getting some interest on my money. I mean, he had $120,000 in the bank, Jess, at 0.01.
Wow.
It was pathetic.
Wasting opportunity, yeah.
Pathetic. And I said, look, it's not on you. Your bank is supposed to be, you know, your partner. And, you know, in this case, they were not very proactive at all. And I said to him, you need to go down there and tell them that you need to get more money or you're leaving. Simple as that. So he did, and he got more money. So I'm happy for him. and I'm glad I could have helped them out there. But we all need to be more proactive. So people understand that bucket. And the last bucket, Jess, is what?
The fun bucket.
It's Jess's favorite
That's
bucket.
my favorite.
We have to start with that last because you got to take care of all the other stuff first. But yeah, the fun bucket is definitely key because and this is the tough part, it's money that is designed to be spent. And everyone has that mentality when they retire. I need to save. I need to save. I can't touch my principal. Oh, my God, I'm going to break rule number 1. No, that's the craziest rule in the history of mankind, all right? You don't spend your principal if you're not replacing it somewhere else. Now, that I get. But if you're doing and setting things up correctly, you should have a pile of money that is designed to be spent on vacations and doing stuff that you wanted to do that you really couldn't get to while you were working. That's what I'm trying to do for people is to say, look, let's look at your retirement more proactively, and let's give this money a purpose. I mean, literally, assign it a task. All right, so you know that this pile is for income, this pile's for inflation, this pile's for emergencies, this pile's for fun. And if that makes sense to people listening out there, then give me a call at 508-552-3230. Give me a call, and we can sit there and do an income plan to show you what you can get, not hypothetically, not potentially, not maybe, but what you can actually get in dollars for yourself, and if you're married, your spouse, okay, that will be there for you 100% guaranteed, along with your Social Security, and hopefully you have a pension too, which is awesome. Then we can go from there to the next bucket for the inflation, which you've already got probably in your IRAs and 401ks, then emergencies, and then fun. That's the logical way to look at your future, is with income first and not hypotheticals. Okay, so that's what I can do for you.
Get more details on the website fairwayfinancial.net. That's fairwayfinancial.net.
Steve Anzoni is a licensed insurance provider by the Division of Insurance and is not registered as an investment advisor. Insurance and annuities offered through Steve Anzoni, Massachusetts Insurance License 3851053. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Read your contract for restrictions, limitations, or penalties. Steve Anzoni is not licensed in all 50 states. To find out if Steve Anzoni is licensed in your state, please call 508-398-3337.